But we also have Hemang Jani now joining us on the show to talk more about markets. Very good morning to you, Hemang. And I think this morning we did not anticipate, at least last night, or rather yesterday when the markets were closing, we did not anticipate. The first thing that we'll talk about is this bolt out of the blue coming in from Federal Reserve. The fact that the dot plot indicating only two rate cuts come next year.
Yeah, good morning. I think after going through weakness in the last 2 days, I think this was clearly not expected, and I think the way the entire event panned out, wherein the rate cut guidance has been only muted, and only two rate cuts is what the Fed is looking at. And maybe probably because of the way the US markets also had gone up in the last, let's say, about 6 months or so. So typically, the market tends to create hype around certain events, and when you don't see something running out as per expectation, there is a huge swing in volatility, and which is what we are seeing over there. I think from our perspective, maybe you could see a bit of a negative start, but our market is actually segregated into two halves. One is the index based companies which are going through a bit of a weakness, but at the same time the broader market, certain pockets are actually showing a lot of resilience. So I think we should be a little more careful about what we are getting into. I don't see much of an impact for the IPO companies. We are going to have an interesting listing, also certain mid cap pockets, so not too much worried about that part. But yes, at the index level you could see a bit of a weakness because of the global backdrop.
Yeah, that weakness is definitely expected today. But the big question is, how long does it persist? Is it going to be a one-day fall kind of thing and we recover slowly? Or is it something that would just take away whatever gains we had made since November 21 in a bit of a hurry? We'll have to watch out for that. But Hemang, I also wanted to put the spotlight when it comes to the Q-commerce sector, and especially take a look at Zomato. I mean, the market capitalization of Zomato is now close to 3 lakh crore rupees. Who would have thought that that company would quickly go to that mark? And this is, versus the likes of Tata Motors or a Bajaj Auto, even DLF, Avenue Supermarts. All of these companies have a market capitalization lower than that. Do you think it really deserves this kind of valuation and market capitalization? What's the way forward?
So, Anisha, typically, whenever the theme is in the limelight, people tend to chase that theme and stocks. And this is not the first time or the last time that we're going to see that. Time and again, you will see that happen. And, when the market is in a situation where there are fewer and fewer companies where you can see a growth visibility, both quarter on quarter, YOY, and more so when the companies have turned, operating profit wise a little better off. Clearly, this is going to create that excitement. Market cap does look a bit stretched, but remember that, in the next 2 or 3 years, given the key operating parameters that the company is working with, you could see some justification for that. So I would want to play this theme maybe for some more time. I know at the end of the day that, somewhere down the line when we have too many players, all these growth related things that the market is hoping for, there can be some disappointment. So need to be little wary of what level you're getting in, and more importantly, you have to be nimble to get out. So yes, I think short-term tactical play, I do like Zomato, Swiggy, some of the other platform companies.
As far as this quick commerce is concerned, because while of course Zomato is something that we discuss and the kind of market capitalization, I wanted to understand from you, what would you rather pick, Zomato at this point of time or Swiggy? Because a slew of initiations have happened on Swiggy over the last 4 days, right from a CLSA to a JP Morgan today, so to a Bank of America, a lot many others like Axis Cap, etc. as well, and they continuously keep talking about the fact that it's not going to be a one player market. It is going to be a multiplayer market, and even if Swiggy is number 2, it does offer a good bet, because the discounted trades at versus Zomato is still quite substantial. What would you rather pick right now, Zomato or Swiggy?
So clearly, given the valuation gap and the fact that, in terms of growth, both the companies could show a similar kind of a growth, and there are enough triggers in terms of, growth that one can really look at. So Swiggy appears to be a little more attractive, but at the same time, what we must understand is that ultimately, wherever you see the surprise element in terms of growth, market would chase that. Also, Zomato now is part of the Nifty, and typically when you see some flows, either ETF related or otherwise in one of the global indices, then that creates its own impact on the stock. So definitely from a fundamental standpoint, given the 30-35% kind of a discount at which Swiggy is trading at, that would be a preferred bet.
Hemang, but let me come to you. I want to know, understand about the cement sector. This year has been a year of consolidation for the sector. At the start of 2024, the amount of players that were there in the cement industry, as we end the year, the number is much lesser than it was. But the issue is that there are a lot of other segments also that have not played well with the cement sector, especially the pricing front.
Yeah, so the sector has been going through slowdown, and despite the consolidation with two major players commanding almost about 75-80% of the capacity, the fact is that when you look at the operating performance, it's not been the best that one can really expect. But there is a sense that as you see the pickup in the infra, the government spending, and the rural side recovery, you might see good growth come back. Prices have started inching up, particularly north, west, and eastern side. Southern market still, there is not much of clarity. So I think from a risk reward point of view, from a purely next, let's say 3 or 4 quarters profitability point of view, the sector does look attractive. And it would make sense to go with either some of the large cap names like Ultratech or some of the regional players, be it Dalmia Bharat or JK Lakshmi.
It's been a good year actually for select cement companies, because cement is one sector where pricing power surely seems to be coming back, both in terms of the demand and also in terms of the consolidation which has happened in the industry. Tata Motor was a high flyer. Tata Motor now is in a reverse gear. And why is this happening, Hemang? I mean, any thoughts here? Because it was always a play on JLR and EV. It was always a play that sooner than later Tata Motor will be split into different entities, CV being separate, your EV being separate. If those factors are at play, then why the stock has gone down from 1200 to 700?
So Nikunj, as we all know, Tata Motor and JLR has been a bit tricky stock to track, given the kind of presence that they have across key markets, and the dynamics in China, Europe, US, and the rest of the world could be very different. The fact that the overall outlook in the last two con calls has been muted, because as we all know that whether it's EV or the normal IB engines, there is a bit of a slowdown across many parts of the world. And India also, if you see, Nikunj, the CV cycle is not looking that good. And even on the passenger vehicle side, Tata Motor has been struggling. So I think given the issues and the news flow around us, clearly the stock which did so well, is going through a bit of a correction. I'm not too excited by the EV play per se. As far as global markets are concerned, yes, India, maybe there could be some excitement, but people would prefer pure play, EV companies rather than going for a hodgepodge like Tata Motors. So I would stay away from Tata Motors at this point. If I have to bet, I would go with M&M, which looks to be a much better, cleaner bet at this point of time.
Okay, point taken. Hemang, wanted your take regarding the pharma sector. Yesterday, that was something which was doing very well. Of course, the defensive. Hopefully, maybe today that holds up as well. And this morning, there's an upgrade coming in from Nomura on Dr. Reddy's. They've upgraded the stock to a buy. They are saying that the relative underperformance of the stock suggests that the concerns about the high contribution of the Revlimid are priced in. They have reduced the target price a bit, but overall their rating on the stock has increased to a buy versus neutral. What would be your top recommendation within pharma?
So clearly now that CDMO is out of flavor because of the delays and the kind of news flow that we had. So we are trying to avoid from that space. But within the generic play, I think be it Sun Pharma, Cipla, both appear quite attractive. Even Lupin has got an approval today morning with certain exclusivity of 180 days. I do not know exactly the size of the opportunity. But clearly, I think these companies are looking quite stable. The price erosion in US has stabilized, and the specialty product portfolio of Sun Pharma has started doing pretty well. So I think some of these companies would provide a good stable earnings growth, let's say 14-16% over the next couple of years.
Take on real estate space, Hemang? How is that one looking? Because it's seen a very good run over the last 2 to 3 years. Actually, post-COVID, realty has been one of the favored picks, even if we talk about the in an asset class way, or even in the equity markets when you're selecting the sector. But what's your take on this one going ahead? Do you think in 2025 it will be able to live up to the expectations?
See, I'm not too sure about 6 months, 12 months, but at least let's say if you look at next 3 months or so, and particularly this quarterly earnings, definitely the sector looks good. I think if you look at prominent players, be it DLF or Loda or some of the regional players also, including this Brigade, Prestige, the overall data point in terms of new sales has been quite good. And we do think that balance sheet wise, these companies are better placed. My only concern is that the stocks have run up quite a lot. And once you see a bit of a lull in terms of the new project launches or the sales that they're doing, the market could react a bit negatively, because it's a high beta sector. So yes, momentum play, quarterly numbers play. I would be positive on some of these names like Lodha and DLF, but I am not comfortable buying into it from an investment perspective, given the stretch in the valuations.
Okay, not buying afresh, but holding on. Thanks, Hemang, for joining us today. We'll let you go on that note. But
if you like this video, then like, share and subscribe to ET Now.